Well, happy Tuesday to you. Joe with you here. It's the 18th of June. Let's get into a market roundup. You guys know the drill. I'm going to talk about meaningful news of the day. We're going to break down the charts technically. We'll also talk about some trades that we can share with the community.
Disclaimer. This video was created for professional stock and option traders. Maverick Trading is a proprietary trading firm that employs professional traders around the world. Our traders trade firm capital and keep 70 to 80% of profits they generate. All trades and analysis in this video are for professional traders only. If you are interested in becoming a professional trader for Maverick, click the apply button in the video description. Let's break down what happened today.
Moving into our market analysis, folks, we had what I refer to as an inside day, but boy, you take a look at these charts, it doesn't look like it was too much of a hesitation, although it was. How do we finish overall? Absolutely flat. S&P a 0.25%, Q's pretty much exactly flat. Even the Russells put in just over 0.25% there. Oil and gold continue to move a little bit higher. However, the majors were pretty much completely flat on the day. Let's take a look at the advanced decline line. 42 declining, 54% advancing, which I would expect since we did finish slightly higher above. Below that 50-day moving average remains 50-50. This does still kind of lean towards the strength is where strength has been and the weakness remains weak. There are a couple of sectors out here that might be flip-flopping. We'll keep an eye on that. Corey made mention of this yesterday, but I'm going to elaborate a little bit deeper today. Moving into the daily news, all three majors take a small pause today after a strong surge on Monday. I truly believe the majority of this was kind of marinating what happened with the CPI on Wednesday. We did gap up after that CPI and kind of the Fed stance and just didn't really do much. I talk a little bit about this, like we might not get the reaction to the Fed on the Fed day. It might take a day or so. In this case, it looks like it took over the weekend because Monday came in as gangbusters and we just shot right up. Well, after that, you get a day like today, which is just that, well, what do we do now? So I do believe it was likely follow through from last week. Inflationary data has been smoothing. I was going to say easing or retracing, but I think smoothing is a better word for it. Retail sales were lower today. You do want you want retail sales higher. You want an active consumer. However, if they're shying away based on higher interest rates and the inability of liquidity, then it does warrant maybe, hey, we could cut rates. So it actually helps with the smoothing of the inflationary pressures. So let's just jump straight into it. Well, here is our SPX chart. This is exactly what we've been talking a little bit about. We have had a +3 for quite some time. And this is starting to look a lot like the Qs have as of late. We do have that consolidation that I've been talking about, and I'm going to quit talking about it because it is, yes, definitely getting boring. Because what has happened, we have broken above a resistance area and actually have established kind of a new point to start recharting moving forward. Let me just emphasize that again. So once we gapped up here, and folks, this is usually on some sort of event or news. I'd like to see more volume behind this based on a CPI number that shows inflation is cooling a little bit and a Fed that actually acknowledged it. So we did get a gap up, a little consolidation, and we're starting to leak higher. What does create a little bit of an issue is when you have price action this far above a moving average. You have this retraction, and we have seen this quite often. You push, you pull. It's a rubber band, right? So the last time we saw a decent extension off of a pivot point was back in this area. Now, folks, I know we're looking at the moving average and stuff, but what I really want you to focus on is from where this started to where it ended. And it is super similar to what we're kind of seeing here. So expectations of a consolidation, a move sideways, or in this case, a pullback is very, very high. And why I'm doing this is because I'm kind of preempting why I have this as a +2 market and not a +3 market, is because we're just extended. It does not mean this is bearish at all. It just means it's a little overextended, maybe a little bit euphoric. People late to the party to get into some of these high flyers that might get a little bit of a haircut if we consolidate or pull back. So it's just cautionary. Moving over to the Qs, you can see it's almost the exact same thing. It's interesting to see that the SPY is actually caught up to it, but it's got this same pattern. We've been watching this pattern for quite some time. It's extended. Same idea. This is right here. This is the gap that we had on the Wednesday, but you can see it's a little bit different than what we saw fall through wise when it came to the SPY. This actually just can't continue higher. And the reason being is because this has the instruments that people want. This has Nvidia, this has Apple, this has Microsoft, this has anything AI, this has the next greatest thing. So we are absolutely, for my traders who I've talked with over the last few weeks, of course it's the FOMO traders. Of course people are chasing performance. Of course people bought Apple because of the chat GPT announcement. It's of course, but it is happening. So how long it goes? Well, it just depends on how much money's on the sideline that really wants to jump in. And then we will get a little bit of a snapback retracement or even a consolidation. But right now we are in the acquisition phase, meaning there is money coming into these markets and they are acquiring some of those hot stocks. So if we move directly over to the heat map, you can see what's participating. This is a complete flat day, but take a look at Nvidia, 3.5% up. We have seen a little bit of a move in the financials. One I will focus on, the financial sector and the industrial sector. Those are the two I really want to focus on because there is two levels that they could be at. They could be coming up and showing some strength. There are some financials that I do like. In fact, one of the choices I have to the upside is Hood, Robinhood, which is the financial sector. Well, Hood is a brokerage firm versus a larger bank, but it does have a very nice chart. So two sectors that I'm actually going to be focusing on is the financial sector and the industrial sector because they could go either way. They've got some pretty bearish chart setups, or it could be the change from bearish to bullish. Other than that, folks, we are seeing weak staying weak and strong staying strong. Energy, real estate's actually doing pretty good in there, but utilities and energy are just not there. On the other end, technology and communication services are unstoppable. So we do have some polar opposites going on. So where does that put us? Well, I'm just hesitant. I went from a +2 to a +1. And folks, that's why we have a weekly and a monthly outlook. It is absolutely blind across the board, +3. Uptrending, bull market, bullish sentiment, bullish reaction, price action moving higher. All the indicators that we look at are doing well. Weekly outlook, it just, I hate this word, feels overextended. It doesn't mean that it is. It doesn't, well, it looks that way, but it doesn't mean that it's going to fall apart or turn around. However, if I was to throw a couple of darts out there to the bull side, I'd want to make sure that they're a lot longer term, or I wait for some sort of a consolidation pattern or corrective action before I do so. I am absolutely not interested in getting aggressively bearish, that is for sure. If we do catch a pullback and a corrective action, and we happen to find ourselves in the worst of the worst, or the bearish, and this has happened to a lot of us, you might catch yourself in a bounce, meaning the markets are falling apart, but your bear stock is having a very nice rally. Well, that's how these things work. So make sure that you are diversified, make sure that you are balanced, and let's not go chasing anything. So let's get into the trades that I have today. I've only got a couple. I just figured I'd just throw out a couple just to talk about. But once I get through these, I'd really like to kind of show you what I'm looking at when it comes to the sectors. Now, folks, we do have a holiday, which is interesting because this holiday is in the middle of a week. We got Monday, Tuesday. We got Juneteenth, which is a holiday tomorrow, so the markets are completely closed. And then we have Thursday and Friday. So it's going to be very interesting. Do people come back and trade Thursday and Friday? Do they sit and kind of marinate over Wednesday and we get a huge volatile explosion to the upside or downside? Or does nobody care? It's really interesting to have a day off right in the middle of the week. So we'll see how that pans out. What I'm going to do is I'm going to spend my time doing a little bit more research on the overall sectors and see if I can't see any sort of change in sentiment. But right now it is 100% to the bull side. So let's start with our first bull trade. This is Hood. It's early yet, and I can be early yet because I know I've got a day off tomorrow. I know that the markets will be closed. I know I can wait, set this up, wait for it to kind of exceed something a little bit larger than most. I mean, it hasn't even shown a pivot point yet. I just love this move. I love how weak this volume is. Right at that rising 20, I can draw a line here. It's setting up for a really cool, maybe a little bit of a shadowed candle on Thursday, and then maybe some follow through on Friday. But I do like Hood here. I think it might be a cool bull pullback. It is about a day or so out, but once again, I'm a day or so out at least. I might not be making too many trades come until maybe Monday. But if this does trigger, this is something I'll be looking at. Now, this is not going to be a +3 trade. This will be like a +1, maybe a +2. I don't think I'm going to exceed much higher than that 24 resistance. If I do a 25, I might be looking for maybe a 21.25, within this range, and that would probably be +2. That's about as aggressive as I want to get in any sort of bull trade here. Why is that? I believe the markets are a little extended. Difference, folks. They're not overextended and they shouldn't fall apart. It's just a little extended. So I want to be a little bit more cautious. Let's move to the sideways. This could also be bullish very quickly. Another online brokerage, right? Coinbase. Coinbase is hanging in there. It's in the financial sector, which is waffling. Financial sector could come back. It could roll over and fall apart. But I did like both of these, Hood and Coinbase, because of the performance that they have relative to their sector. So it's got a little bit of a consolidation here. I do like how the 20 has crossed over the 50 as of late, but you can see it's a little anemic. We didn't quite get above resistance levels that I like to see. Of course, we want to see it exceed their highs here. But we did, in turn, kind of revisit a little bit of resistance area. Yeah, folks, this candle that's gapped up and come down, I'm going to call that, kind of the area that it's at. I'm going to include a grouping of candles for that line, not so much where it gapped up and traded back down. I do like how it correlates with a resistance level set early in April. And then here we are back there. Now, this could easily roll back over. What's tough about this is we are susceptible to a weakening financial sector. And if that happens, well, this is going to hit that 50-day moving average and maybe fail upon it. What I'm waiting for, just like the previous, is if I can get a pivot point at that 50, well, then I've got a resistance back up here around that 160 level, maybe a little lighter, 158, 160 level. So I could play a range. So this is going to be sideways if I see a pivot point here, but it's going to be a shorter term sideways as it approaches this level. So as you guys can see, I'm actually putting up a couple of trades that do have a few days to get there because of the fact we have a midweek holiday, and I am in no rush, folks, to throw trades on. This is Bristol Myers. This is one of the weaker I can't say that anymore. One of the sectors that I believed was a little bit weaker. This is in the healthcare sector. It's interesting enough because the healthcare sector has had a very strong bounce off of some of its lows over the last few weeks, but I am still finding charts like this all over the place. So I don't want to get super bearish because you're just fighting the overall sentiment trend. And I know that, hey, the sector's had a pretty good bounce, but I'm still seeing a lot of stocks doing this. So how do you play this? Well, how about a -1, a 0 to -1? I do see a lot of shadows, a lot of legs in this area. So I don't want to get aggressively bearish. No way I'm doing a -3 or -2. In fact, folks, I'm not doing a -2, -3 in anything with the markets or the sentiment this bullish, but 0 to -1, seeing if this can't just kind of bleed back down to that $40 level or something sideways to down. This is where your put calendar spreads can work. If you do a 40-40 put calendar spread, that's kind of cool. Sideways to down, it goes sideways. You can make a couple of bucks, but it's just not doing very well here. So with all that being said, folks, since I'm not really rushing out to jump into any sort of trades, I really do want to share this with you. So let's just jump out to some charts here. Now, this is a zoomed out view of the SPX. Well, that's great, Joe. I've seen this 1,000 times. Well, let's just jump out to the triple Qs. Oh, geez, I've seen this as well. These are extremely extended charts. We got a euphoric buying going on. This could be late to the party, the last ditch effort. Hey, we got the CPI we wanted. Everybody could refer to this as a blow off top or overextension. I'm cool with that. That's great. However, we shouldn't act on it until we see it fail. So if we can't judge anything based on what sentiment's doing and the overexuberance and the stuff that's euphoric, well, why don't we focus on the stuff that's not? So let's take a look at the diamonds. So what's cool about this, now you can take a look at the diamonds. This is a very different chart, isn't it? Extremely different. But it's at a pretty significant level. And I'm going to start to zoom in. Now, the diamonds, folks, are primarily, or I should say the Dow Industrials itself, is primarily built off of industrials, energy, utilities, and materials, right? Now, energy and materials are just not doing it. So it's this last few candlesticks that I'm actually focusing on. And if you take a look at maybe a larger picture here, we're starting to see the emergence of, well, that could be a higher high. And we're getting ourselves a symmetrical triangle pattern, which could break to the upside. So The big question is, are the lagging sectors going to consolidate and catch up, or are they just oversold bounce because of the euphoria and some of the outperformers, and this is going to roll over and fall apart? That's the million-dollar question. Well, since I'm not going to get any sort of good read out of the euphoric side, let's take a look at some of the underperformance. So let's jump through some of these sectors. So this is the diamonds. Let's take a look at XLE. This is energy. Now I want to zoom back out, folks. I'm doing this on purpose. I don't need to chart this day to day. I just want you to get an overall idea of the motion of the ocean. Energy is absolutely forgotten. It's never had a chance. Anytime it's got a blip, it gets sold into over and over and over, right? Doesn't mean that the world's coming to an end. It's just this sector has been out of favor and out of favor for a while. The other one we want to take a look at is utilities. Now, utilities did have a pretty good bounce today after a gap lower. I'm not going to zoom in. I just want you guys to get a feel of the overall motion of the ocean. We'll talk about this over the weekend class, but not quite participating. Now, a couple of sectors that are kind of emerging is the financial sector. Now, the financial sector here was rolling over, and one of my favorites for bearish setups. I had a bunch of bears I was looking at, but they never really confirmed because I got caught, or they got caught, I should say, in an oversold bounce. Now, it's an oversold bounce for now. But this candlestick showing that it did close on its highs at this level is a little bit more optimistic, but we need to pay attention to the overall trend itself. So this is the area that I'm focusing on when it comes to the financial sector. If it rolls over, this could continue that descending triangle pattern. We're right back down to the lows to where we could break down and fall further. However, if all tides indeed raise ships, then we would expect this to continue higher. We would see more money come off the sideline, and we could push this above this level, and this becomes nothing more than a bullish flag pattern. Two different ways to think about it, but what I love most of all is we don't have to think about it. We can just sit there and watch it. The other sector that was a head scratcher was the industrials. This is XLI Industrials, also a Dow component, very similar to the financials, except we do have the crossover of the 20 and the 50. So this is almost more bearish. However, these two candlesticks look a little bit more optimistic. But if we indeed have a doji, now we're in for something a little bit different than corrective action. So what's staying weak has remained weak, and what's staying strong has remained strong. So I threw out both of the extremes. Now, what this should do, folks, is keep us from chasing performance or underperformance. And that's kind of the whole idea that I want to do here is, yeah, we've got our portfolios, we got the exposures we see week to week, we've got our overall monthly indicators. However, how do we get rid of that shorter term volatility? How do we curb it? Well, the idea is to throw out the stuff that's driving you crazy. Is this a strong enough market to where, hey, I'm willing to throw some money into some of those underperformers just because, hey, we're optimistic, let's do this? Or is this just an overexuberance which will eventually pop? All that theory aside, we're just kind of left with what the markets do. So just be slow to make decisions and let's follow what happens. The markets are closed tomorrow for the Juneteenth holiday. Keep that in mind. It's a good time to step back, take a look at your exposure, take a look at the sectors, and really focus on where you're placed and why you're placed there. Jobless claims, Philly Fed, leading indicators, that all comes up after the holiday, Thursday and Friday. I wouldn't be surprised, actually, folks, if after the holiday we get another surge, either up or down. So be aware that it could be pretty volatile on Thursday. Don't let that really pull you one way or the other. Let's just make sure you follow your overall charting. Focus on your overall top-down approach with the markets. If you're really worried about it, folks, like me, I'm just going to kind of sit out, see how things play out, focus more on a kind of a macro scale, watch the sectors, and then I can make my decisions over the weekend into Monday. There's no rush for me to really push any buttons. As always, folks, check earnings reports if you want to avoid any sort of unnecessary volatility or unless you're looking for it. Regardless of what you guys decide to do or don't do, just make sure you follow your trading plan, position size correctly, right? Thanks for joining me, folks. Enjoy your holiday tomorrow, and we'll see you next time. Bye, everybody.